Learning how to manage your credit will ultimately save you thousands of dollars. Your credit score has now become the most important number in your life if you want a home loan, auto loan, the best insurance rates, lowest APR credit cards, employment, or advancement in your current job. FICO score is a three-digit numerical index which represents an estimate of your financial credit worthiness. It is the most important number lenders use to determine who qualifies for a loan, at what interest rate, and what credit limits. It is based on a subset of the information in your credit report, typically from the three major credit bureaus, Equifax, Experian, and TransUnion. Though the scoring system used by all three credit bureaus are different, but all point to one conclusion, and that is whether or not you have good or bad credit. Creditors or lenders, such as banks and credit card companies, primarily use FICO scores to determine credit limits and interest rates every time when you apply for a new credit card, mortgage, auto loan, personal credit line, or any other credit issues by the bank. These scores have proven to be very predictive in assessing the credit worthiness of a person or the likelihood that that person will pay his or her debts. FICO scores range between 350 and 850. The higher your credit score, the lower the risk is to the lenders and the easier you'll obtain a loan. A low score, such as 500, could result in much higher interest rates, larger down payments, or having your application rejected outright. Conversely, those with a credit score of 720 and above would get the most favorable interest rates. When applying for a home loan, your credit score will determine the amount of down payment you'll be required to have and the interest rate. Your interest rate determines your monthly payment over the term of your loan. Although interest rates have dropped, the lenders are now looking for a higher credit score for you to qualify for the best loan programs. Your credit score not only determines the rate of financing you will have, but subprime lenders charge the auto dealers high acquisition fees when selling you the auto. The fees are added to the cost of the sale, which you wind up paying for. Most auto dealers use only one credit report. Find out which report they use and what minimum score you will need to get the best financing. Most insurance companies use your credit score as a determining factor when deciding how much to charge you for insurance. The reason a person's credit score is weighed into the equation is because the insurance companies have studied credit scores and risks. Those who pay their bills on time are considered more stable, and stable people are considered less of a risk. While lenders are interested in your credit score as a measure of your ability to repay the loans, the insurance companies are interested in determining what type of person you are. Those whose credit is maxed out or shows a history of unreliable payments will be looked upon as reckless and risky. If you have a bad credit score and live in a state that allows your credit information to be used when calculating insurance rates, you can expect a higher premium. Positive credit or lack of positive credit has as much more impact on a credit score as negative credit. It's suggested that you have at least 3 open revolving charge cards. Revolving credit shows you have the ability to control your spending while managing to make your payments in a timely manner. Having a high credit score will determine the credit limit, the APR, and annual fees, so it's very important to check your credit rating before applying. Employers are more likely to use credit reports as a way to verify employment history and Social Security numbers. Lenders often verify employment when you apply for a loan or credit card, so a credit report is seen as a good way to double-check the employers listed on the job seeker's application. The rationale is that people with large debts or other credit problems may be more likely to steal or commit fraud. Even if a job doesn't involve money, some employers are convinced that people who manage their credit well are better workers than those who don't. Many Americans these days are discovering the catch-22 of unemployment, and that is, you might fall behind on your bills because you've lost your job, and you might not be able to land a new job because you've fallen behind on your bills. Click on to How It Works to learn how our credit management program can benefit you.